So I really like using Excel for a lot of things. I made some more slides using Excel to talk about how the WACC works, the weighted average cost of capital. It basically looks at dividing the risk of the operating company into two components. There's an equity component and a debt component. So the owner of the business who's invested their equity into the business, they're typically going to expect a higher rate of return for that increased risk. It's their money they've invested. If there's debt capital, that's going to be usually a smaller return because it's an interest rate for the most part. So it follows kind of the OPM method of investing. OPM stands for other people's money. So the idea is you blend the two different risk rates together to come up with an overall risk rate that can be used to appraise the company. So the blending is the weighted average. That's how that works. So the basic formula is right here. An awful lot of Greek, and there's the explanation of what it means. So you have the quotient of the required rate of return for the company's equity position times the weight of that component plus the weight of all the debt components. And that 1 minus t is going to have some explanation further on. So I want to break all this stuff down in a little bit. This is a boring collection of math figures, algebraic variables, but also need to pay attention to if the company that you are appraising has some Class A and Class B shares, this formula will get more complicated. This is just the basic version. And because this is boring and black and white, I'm going to add some colors. I'm very interested. Let me know in the comments below if my adding colors was helpful or useful at all. So let's talk about the KE here. Let's look at required rate of return for the company's equity position. The most commonly used method to derive an equity discount rate is the build-up method. And if those of you who aren't familiar with it, give me a call, we'll talk about it later on. But the build-up method, so basically the KE component is equal to the sum of the following, which is the build-up method. A risk-free rate with an equity risk premium summed with a size premium and a risk premium for the company's specific risk. A business appraiser has to determine how much more risk should be attributed to the subject company being appraised than what can be observed in public markets. And we're going to use 21% in this example. So remember that number. Cost of borrowings. That's the KD. See the red and the red lining up? So often a company will have a bunch of different loans for a bunch of different things, and each one will have a different interest rate. So in those situations, what I like to do is I'll do a weighted average of all of those interest rates based on the percentage that each loan takes of the overall debt, interest-bearing debt that the business has. So I do that for a couple of reasons. One, because I think it's kind of ironic that the weighted average cost of capital is going to be relying on another weighted average to get it done. So please note, there is no aspect to the formula here for the WACC where an analyst can modify that cost of debt with the inclusion of however much more risk is assigned based on the owner pledging personal assets to guarantee that debt. But it does happen. In small businesses, business owners have to sign a personal guarantee. And that modifies that overall cost of borrowing a little bit, but it's not taken into account here in the WACC. So weighting of the equity. So the WE there, weighting is the percentage of the company's equity in its overall capital structure. But here's a question. If we already knew that ratio, that percentage of how much of the company's capital structure was made up of equity, then why would we be going through this exercise to come up with the value of the business or the equity? Because we already knew it. So the WACC requires us to already know the answer before we can determine the answer. Those of you who have built a WACC and analysis in an Excel spreadsheet, you would come across that circular reference error, right? Of course, right. So there is a way to iterate the weight of equity, but most analysts who use this method, what they tend to do is look at the capital structures of publicly traded businesses because you can identify there's the equity and there's the debt components. You can do the math and see what the ratio is and use some kind of amalgamation of those various percentages in order to come up with what's called a quote-unquote ideal capital structure breakdown. And then they incorporate that for the analysis of the company that they are appraising. More on that in just a little bit. In fact, on this next tab, I believe. Weighting of the company's debt. So once you've selected the percentage of equity, whatever that is, if you looked at publicly traded companies and you say, well, overall, the average of however many of these companies are you can look at, debt or equity is based on a percentage, say 35 to 65. That's the ratio you're going to use, fine. But once you have one of those ratios, debt or equity, the other one is simply 1 minus the first. For example, if the selected equity percentage is 35%, then the weight of the debt is going to be 65%, because 35% plus 65% equals 100%, or just 1, right? Of course, right. So, are we typically asked to appraise a company as of a specific date? The answer is yes, we are. And on that date, the capital structure of the specific company we are appraising is perhaps more important than some amalgamation of publicly traded companies. Because if we look at whatever analysis we do to try to figure out what that percentage of debt to equity is for publicly traded companies, how close or how really comparable is that to the actual capital structure of the business that we have been asked to appraise as of our effective date? That's something to consider. It may not be very close. Are we appraising the subject business, or are we appraising some hypothetical construct that is a mixture of both the subject business and an accumulation of publicly traded company data? Something to keep in mind. All right. The effective income tax rate. So the 1 minus T, that one is the tax rate should include all the taxes that a business would pay. The federal, state, and if there's municipal income tax, you need to worry about that as well. The reason we need to figure out what the tax rate is because you can write off that interest expense on your income statement or your tax return. There's a tax shield there. We got to deal with that. So we're going to assume if the federal income tax rate is 21% and the state income tax is 6% and there's no municipal income taxes, the effective tax rate would be 21 plus 6 or 27%. Is that right? No. No, it is not. One can typically write off the federal taxes on their state tax returns. The effective tax rate calculation should look more like the following here. So if we assume 10,000 in income, subtract out the Fed taxes, there's a subtotal, then the state taxes off of that. There's your total after tax and income right there. Effective tax rate is going to be the math showing what's left divided by the original above, which gives you an actual tax rate of 25.7%, not 27%. So pay attention to that as well. So we have all the variables figured out now. Let's do the math. So here's all the colors in place. Here's all the information. So let's open this one up here. We'll run the math through. So there's going to have the cost of debt portion of the weighted average cost of capital and the cost of equity portion. So looking at this one, start with the interest rate, do the tax shield. So 1 minus the tax rate gives us that times that, so interest rate times the modified tax shielded math gives us the net rate of 6.1%. And if our market value of debt is 65%, which we discovered earlier on, then the math, this times that, is the portion of the capital structure's debt capital structure, whatever we're going to call that. So the equity is simply the net rate from the build-up method times its percentage, right? And we sum all those together, meaning the WACC would be equal to 11.315. So what happens if we change the cost of debt, say that the business has more equity funding it? Let's just reverse these. 35%. Notice the risk, or the WACC, goes up higher. Well, what if we have very little debt? What if we have no debt? Then using the WACC basically provides you exactly the same risk rate as the build-up method by itself. So if that's the case, Do we need to do the WACC? We have using the bullet method to come up with our discount rate? Maybe, maybe not. Depends on what you're doing. So I was hoping that some of this would be useful, and if it was, I'd love to hear about in the comments down below. And as always, if you have any other questions or comments, feel free to reach out. I'm happy to talk about valuation stuff. Have a good rest of your week. Bye.